Now here we're going to turn and look at what's happening in the U.S. Inflation is still a concern. It's still an issue, but it came in with right along expectations. And there's some good sides and some bad sides. And we want to look at what is going to really drive things as we go into this month and then into really the end of the year. And it's interesting because bond volatility, which is measured by the MOVE index, continues to be elevated. It's levels that we haven't seen except going back to 2008. It's even above where the MOVE index was, or bond volatility was, during during COVID. You can see that there was another spike when we had the failure of SVB and some of the other banks. But it's still elevated, and we don't see that changing. Now, the VIX, which is measuring equities, that has come down. It's come up a bit, but there's still this broad disconnect between where bonds are and where the equities are. We've had the U.S. downgraded. We've had a multiple amount of municipalities as well as U.S. banks have been downgraded, but yet there's still this. And not to say that there should be a massive change in equity pricing, but there's still this view that everything is okay because of this mantra of, well, it'll all get taken care of. There'll be bailouts. Powell's going to pivot. And one of the things that we've been saying is that Powell's stuck. And one of the key pieces when we came up, and for those that have been following us since 2020, this is very consistent. We've said, even if he wants to pivot, if Powell wants to pivot, if the Fed wants to pivot, they won't be able to, because they're stuck with where yields are, with where, you've had this massive amount of stimulus over the last 10, 15 years, that there's really not much that can be done. And instead you have to look more long-term, and you're going to have to keep things much tighter than maybe they would have wanted to, which is why we talk so much about what happened in the 70s, where they started cutting because they thought they got in front of it. And then you got this reacceleration. And when you look at home prices, when you look at wages, there's a lot of stickiness there. And that's not something that they want. They want to get in front of it, or they need to get in front of it, because if they don't, you're going to get a massive acceleration, as we've seen in previous years, or I should say in previous cycles, on the inflation front, creating that wage price spiral and that problem. So CPI on the consumer side, month on month, what came in at 0.2, it was technically 0.9. I'm sorry, 0.19, but again, just kind of keeping it simple at 0.2. When you look at the less food and energy, came in at 0.2, again, right in just above where we were last month. And that's what we were saying, is that we were going to start to see a bit of an acceleration, which really started in July and didn't happen right away. Remember, the things in July started a bit softer, and then you started to get that acceleration as we had the move up in gasoline prices and diesel prices. And then when you look at the CPI categories, you can see airfare was down huge, used cars and trucks was down big, electricity has come down as well, hospital services. But then when you start looking at fuel oil, natural gas, gasoline is still on that front end of it, and gasoline is still a little bit slower, but that's where we see some of those adjustments going up. And on the airline side, it's not surprising, given some of the slowdowns that we've seen in terms of just activity, where people are just not traveling as much. They're staying a bit more local and opting for places to drive. When you look at the CPI side, you can see that on a month-over-month basis, which is what we've been talking about, it's continuously gone up. You're constantly seeing additions to people's costs. I mean, there's nobody that has benefited over this period. Now, even at the headline level, there was one area where it was just slightly over zero, but on a core basis, it has been a relentless move up, and now you're actually starting to see it reaccelerate, and the food side is not going to help as well. When you look at fruits and vegetables, dairy and related products, meats, poultry, fish, and eggs, you're getting that acceleration again. Now, owner's equivalent rent continues to slow. There is that lag of 8 to 10 months, but now it is going to continue to be a headwind for total CPI, but now you're actually seeing it reaccelerate again, which again is putting more pressure on the longer term trajectory in terms of where that inflation is going to go. July CPI year on year came in at 3.2% versus estimates of 3.3 and was 3% in the prior month. So again, a reacceleration. Core came in at 4.7%, as right in line with estimates. It was 4.8% in the prior. So again, there's getting a reacceleration on the headline. An elevated or stuck level on the core side. Now, owner's equivalent rent portion of CPI saw a year-on-year change ease in July to 7.7%. Still fast relative to history, but down from the peak. So you're still seeing this pressure that is getting priced into the market. Now you have rents moving back up, especially in some of these key areas. And that's going to keep this bid or this problem when you look at, well, how is the Fed going to react? August is going to be very important. We do see August coming in even hotter than July, which is going to put that pressure on the Fed and what the Fed's going to do. We believe there is one more Fed hike of a quarter point this year. Is it in September or later in the year? That is up for debate. I think realistically, they would be, especially based on the data, they'd be more apt to do it sooner rather than later, but they may just want to keep it here and just let this work through the system. But you've seen, even though credit difficulty or hard to get credit remains elevated, it's come down a bit, and they want to make sure that there is more of this pressure to keep that credit moving lower. Average hourly earnings of all employees pick back up, and we'll look at this chart a bit broader, but you're getting an idea that this is sticky. This is not going away, and we're actually seeing wages reaccelerate a bit, and that is a tailwind for sticky inflation. That's a tailwind for service inflation. And that's going to keep them on their heels when you look at avoidance of a wage price spiral and finding ways to really try to get in front of that. This just looks at real average hourly earnings, real average hourly earnings production and non-supervisory. So they've come up, but they're still well below trend. So we are not by any means accounting for inflation. So it started, there was an increase, I think it was 0.2. Inflation went up 0.2. So you're getting it move in the right direction. So technically based on wages, you're not getting hurt, but you're also not getting in front of it. So we've already seen savings completely wiped out. As we talked about last week, you've already seen the savings nut or cushion go away, which is going to keep pressure on consumers. High-term premiums on way as inflation expectations continue to rise. And that's when you start looking at University of Michigan expected inflation over the next 5 to 10 years. It's not improving. It's getting worse because people are experiencing this firsthand. It's very fungible just based on where some of these expectations are. But when you go to the store and every time you go to the store, the price goes up, that's a problem. That's a pain point, which I don't think is truly appreciated when you look at some of the headline numbers. Tighter consumer loans point to weaker payrolls. It points to it, but we haven't gotten there yet. The jobs data is still strong. The jobs data is still telling you that things are overheated, even though there's other areas that tell you things have gotten much worse. But the Fed's job is inflation and full employment. We're over full employment, and we're still well ahead of where inflation expectations are, keeping some of that pressure in the market. And that's why when you look at M2 to nominal GDP ratio, yes, it's come down. And everyone is obsessed with, look at M2. It's negative for the first time in a long time. It's going to be a terrible recession. We need to increase it. It's like, well, you need to look at where the ratio should be and the amount that was dumped into the market. So yes, it's coming down. That is by no means, I don't think anybody would fight that. But the question is, where should it be? And we're still elevated. There's still too much out there. And that's just after years and years and really over a decade of just easy policy. We need to see this come out of the market and really start to tighten things up. And that's why the real rate curves are near the most inverted levels on record. And that's a problem. Again, you're seeing the pressure points in terms of in the bond market, and the bond market is telling you there's a problem, is telling you we're nowhere near fixing it, but yet the equity market continues to move up. And that's where we see concern. And we're not saying sell everything and go short. We're just saying it might be a good point to say, okay, well, this has had a good run. Maybe we should take money off the table, move to the sidelines, and let things readjust. Small business credit outlook has rebounded a bit, but still, it improved, but still weak. But when you look at the Fed and what they're trying to do, they don't want it to improve. They say they don't care. They may just let it happen. They don't really want it to improve because it puts more pressure on them and where inflation and really the velocity of money is going to go. U.S. small business and consumer optimism, when you look at it, they've both bounced up, but it's important to kind of weigh things because as the results, when you look at the NFIB headline index tends to be highly correlated with consumer surveys and impacted by indicators such as the stock market. The stock market has gone up. One key difference is that consumer surveys are adjusted to reflect the representation of political parties. The NFIB is not. But it's just things have not gotten worse. They maybe haven't become great, but that's why you start to see that bouncing around and you start to see a bit of that sideways move. But the bigger, I think, pressure point is going to be the refinancing of maturing debt, which so far, when you look at it, companies have been able to do. But it's increased their interest expense. And it's by increasing interest expense, you're decreasing your coverage ratios. So there's covenants in bonds where there has to be a certain amount of cash on hand to cover interest expense. It could be 2.5 times, could be 3 times, 4 times. It all comes down to the covenants of the bonds. Now, a lot of times you'll get covenant waivers because they're like, look, we don't want to pull you into bankruptcy. We'll give you the waiver. But this is just showing that there's going to be a limit or at least an unwillingness or a slowdown in the amount of new debt that these companies are willing to take because they don't want to tax their facilities. They don't want to tax where things are going because they want to be cautious in case, which we do believe is going to be an extended slowdown. When you look at that coverage ratios, just looking at it a bit differently, you can see it continues to diminish. But then again, so companies aren't going to spend, but then U.S. credit card debt balances on a quarterly basis. Total credit card debt in the U.S. jumped by $45 billion in the last 3 months to a record $1 trillion. Since 2021, total credit card debt is up nearly $250 billion. We went from handing out record levels of stimulus to borrowing record levels of debt. So when you look at that V shape in terms of that credit card piece, so the companies are not going to borrow the same way to invest in the same way, and now we're starting to see that the consumers also tapped out. So who's really going to carry that torch when we look at economic or really GDP growth over the coming few years? Next few quarters. Credit estimates raised and lowered by quarter. We've had credit, as we've been talking about, there's been a lot of downgrades in Q2 of 2023. It's the most downgrades that we have seen since Q2 of 2020, which if you remember, that was when everything went into full lockdown. Debt to income ratio for all homeowners. When you look at the debt levels to income home buyers, debt to income ratio is averaging close to 40% in 2023. Those are near the worst affordability levels on record, according to the FHFA and the calculations here, even worse than the 2006-2007 bubble before the last crash. So debt is high to income, but then the rates are low. So the amount of debt is there, but the carrying cost is lower. So you have to kind of weigh both of those, but you get an idea that, no one's going to be willing to leave their home if they have a 3% mortgage. They're not willing to adjust because they would take an equity hit, which then you essentially have to realize that debt component on that principal level that you can't pay back, which is why we've called that those golden handcuffs. Now, when you look at age and total wealth, as you can see, there's been a lot of consolidation with over the long term. A small percentage of U.S. companies have created most of the aggregate wealth. And then the net percent of domestic respondents reporting stronger demand for commercial real estate loans is now below where we were in 2008, because you're like, well, there's no reason to go out and get more loans. Most companies, and we'll talk about this in the next segment, are looking to shrink their footprint on a corporate level, which is why we're not going to see the same loans component. Now, when we look at the small business, quality of labor has overtaken inflation as the single most important problem for small businesses. Inflation is still a problem, but labor is a problem. But labor is a big component to inflation. So if you still have an issue with one, you're going to still have an issue with the other. Taxes starting to creep higher as an issue because people are looking at their cash availability get tighter and tighter, creating those struggle points. Tighter consumer loans point to weaker payrolls, but again, weaker payrolls, it points to it, but we haven't seen it come out yet. And until we see a meaningful number, because yes, the data points to that, but we're not getting it. And a lot of that comes down to quality of labor, availability of labor, which is why we see some of these pressure points, which is why we have to see additional adjustments. And one of the reasons why we think that we're going to continue to see tightness coming from the Fed. Outlook among small businesses improved in July year on year. Increase was the fastest since September of 2020. In July, business optimism rose from 91.9 versus the estimate of 91.3. Outlook rose to negative 30 while still negative, best since August of 21. Hiring plans ticked up while expectations for earnings trends worsened. So they're still planning to hire, but their earnings are going to get compressed because they know they have to pay more to close the get these jobs, because there is a quality issue, because there is those problems in general, which is why, as we've said, the data is going to bottom and bounce, but it's not going to improve back to expansion. It's just going to bounce sideways at this point. And we do see more pressure coming, especially as inflation picks back up. A lot of this data was taken prior to inflation really starting to bite again when you look at gasoline and diesel, especially diesel when you're looking at the supply chain. And that's something that's going to pull some of these estimates and these expectations down again. Despite continued decline in percent of small business reporting higher selling prices, only 5% cited poor sales. So again, you're still seeing people willing to pay up. And now we do think that is slowing because you're starting to see it creep, but it doesn't happen all the way, all the time. And that's where we continue to see some of these underlying issues. When we look at the NFIB, percent of small businesses with jobs unable to fill, unchanged in July at 42%, 17% expect to add jobs, which is still down significantly from the peak. So it's down, but the job opening is hard to fill. It's come down, yeah, but going back to 1979, it's still at the highest level it's been. It's below peak, but still take away COVID, it's still the highest it's ever been. Hiring plans have come down, but still very elevated, which is why we see that pressure on inflation, keeping things a bit elevated. Then when we look at the through July per the small business reporting, higher prices fell to lowest since February of 2021. Also moved down in percent of planning to raise prices over the next 3 months. So yes, the sales haven't come down, but they're starting to see people say, look, I can't pay that. And there's this unwillingness to test because they want those sales to maintain. So that's, again, going to eat into margin further and further. Growing divergence trend in ISM manufacturing and real GDP. Latter ticked up in Q2, while former has yet to see material move to the upside. So when you look at ISM manufacturing PMI, it fell down again, and why we talk about how GDP is going to be very driven by the consumer and services. So it doesn't really manufacturing doesn't have to pull it down per se, but it's going to keep an anchor on it and really keep it from seeing that real growth. We do think it gets worse because, as we've talked about, services are weakening, consumers weakening. So you will see that downward trend, but it just gives you an idea that there will be an anchor because manufacturing is going to keep that weight there. And especially as it goes sideways and services comes down to meet it, and we go into that more confirmed, quote unquote, contraction as services continues to decelerate. So that's what we have for you on the inflation side, the debt side. Next segment, we're going to go deeper down into the consumer, where that debt sits, how that is shifting some of the spending, and how the real estate market continues to shake out.